Welcome to our second lesson on external sources of finance. Here we'll learn about medium and short-term external sources, along with their pros and cons. Let's dive in. Let's start with medium-term sources of finance. These are typically repayable over a span of several years, usually between 2 to 5 years. Hire purchase allows businesses to acquire high-cost assets like vehicles or equipment. By making a deposit and then monthly installments, a business gradually pays off the asset's cost plus some interest. While this method can provide us with large amounts of finance and is easier to receive than a traditional loan, there's the caveat of interest needing to be paid and the limitation of not owning the asset outright until full repayment. Leasing is another option. Here, a business essentially rents an asset from a leasing company. Once the lease period concludes, the asset is returned. A significant benefit here is we don't need to pay large upfront costs to access expensive assets. Additionally, the maintenance and repairs falls under the leasing company's purview. The obvious trade-off is that the asset will never be owned by the business, and over time, leasing might prove costlier than purchasing. Loans, the staple of many businesses, are sums borrowed from banks to be paid back over a specified period. Unlike hire purchase, obtaining an asset with a loan means immediate ownership. While loans are versatile, catering to everything from startup costs to business expansions and are paid back over a long period of time, they come with the caveat of interest and can sometimes be challenging to secure. Peer-to-peer lending operates outside the traditional banking framework. Here, funds are loaned from individuals, often facilitated by online platforms. Peer-to-peer loans can be paid back over long periods and are more accessible than traditional loans, especially for those with limited credit history. But they can come with higher fees and interest rates. Lastly, in the medium-term finance options, there are business angels. These individuals invest in businesses, expecting a share of the profits. While they can inject funds swiftly, bring valuable expertise to the table and have no direct repayment or interest, they will take a share of your profits and often want a say in business decisions, which could lead to potential clashes in vision. Shifting gears, let's look at short-term sources of finance, which span typically a year or less. Bank overdrafts provide a buffer when an account's balance dips below zero. They are ideal for addressing short-term cash flow challenges, so we can continue to operate. The main benefits are that they are quick to arrange and flexible in their use. But they can be costly due to high fees and interest rates, and cannot be used to borrow large sums. Crowdfunding taps into the collective power of many individuals, each investing small amounts. In return for the finance provided, the investors will often receive gifts in return. This method is not only a means to secure funds quickly and with no upfront fees, but also serves as a promotional tool. However, there's always the risk of not meeting the funding goal or having your idea copied. Trade credit is an arrangement between businesses, where goods or services are supplied with the understanding that payment will follow at an agreed-upon later date. This is particularly beneficial for businesses needing inventory without the immediate burden of payment. There's also no interest to be paid and it is typically easy to arrange. However, it's a very short-term solution, only gives access to limited amounts of finance, and late payments can sour business relationships. In conclusion, hire purchases enable the acquisition of costly assets like vehicles and equipment, offering easy access to substantial finance. However, interest accrues, and ownership is only granted upon full repayment. Leasing involves renting assets over a duration, providing immediate access without upfront costs, but it remains more expensive in the long run, and ownership is never transferred. Loans from banks require repayment in installments, but they attract interest and can be challenging to secure. Peer-to-peer lending involves borrowing from individuals, offering easier qualification than traditional loans, but typically at higher fees and interest rates. Business angels invest in businesses in exchange for profit shares, furnishing quick funds and expertise, but may seek decision-making control. Bank overdrafts offer short-term credit when account balances go negative, providing flexibility and rapidity, but they attract fees and aren't suitable for large borrowings. Crowdfunding sources money from multiple individuals, offering speedy finance and promotional benefits without initial fees. However, Failure to meet targets results in zero funds, and it could lead to ideas being stolen. Lastly, trade credit allows businesses to obtain goods now and pay later, benefiting from no upfront costs and interest. Yet it's limited in duration and amount, and has potential late fees.